Most dads building Bitcoin wealth are making the same 3 mistakes, and they don't even know it. They think they're being smart by watching prices constantly or taking profits early, but these moves actually destroy long-term wealth. These mistakes seem harmless at first, but they can quietly wipe out years of progress and cost you thousands in potential gains. The worst part? They're completely avoidable once you understand what they are. I'm going to break down all 3, and by the end, you'll know exactly how to protect the legacy you're building. Let's get started. 1. Stop watching the price. Start watching how much you're investing. I've mentioned this to you before. Your investment growth depends on 3 things: your annual growth rate, the amount you invest, and how long you stay invested. If any of these increase, your wealth grows. If they decrease, your wealth shrinks. Especially if you're just starting out, the only thing that truly matters right now is how much money you're putting in and how consistently you keep doing it. At the beginning, growth rates or time horizons don't mean much. Think of it this way. Let's say you start with $500 and add $250 every month. After 4 months, you'll have invested $1,500. Now imagine the market drops 50% and your portfolio falls to $750. But by continuing your monthly $250 contributions, you can recover that drop in just 3 months. However, after 5 years, once your portfolio has grown to $40,000, a 50% drop would be much harder to recover from with the same $250 monthly additions. This example may sound extreme, but it helps you understand the point clearly. If you're a beginner, stop watching the price and focus on how much you're investing. When your monthly contributions become too small to noticeably affect your portfolio, that's when price awareness becomes useful, not for trading, but for making smarter, more informed investment decisions. If today you focus on increasing how much you can invest each month, even without knowing anything about markets, you'll still end up with meaningful savings. Had you started 10 years ago, your life would likely look very different today. Don't let yourself or your children regret the same thing in the future. Start now. Remember this rule: don't track the price. Track how to increase the amount you invest. Find ways to earn or free up extra money. A side job, passive income, overtime, or simply cutting unnecessary expenses. Cancel subscriptions you don't use. Eat out 1 day less per week. Every small change matters. 2. Not doing DCA, not thinking long-term, getting stuck trading. Most people think the way to make money is through trading, and in doing so, they miss the real opportunity. I've explained before why trading is a bad strategy. Here, I'm not going to talk again. What I want to focus on is why long-term investing combined with DCA makes sense. DCA stands for dollar cost averaging. As the name suggests, instead of making a large one-time purchase, you spread your investment over time. Whether this strategy is right or wrong has been debated for ages. Some big investors love it, while others argue that since timing the market is impossible, you should invest your funds all at once. These debates are important, but what's often overlooked is that DCA can be far more advantageous for Bitcoin compared to other markets. Bitcoin has specific cycles that occur within the 4-year periods, known as halvings, when the rate of new Bitcoin creation is cut in half. This is much more mathematical and predictable than most other markets, making timing slightly easier. Moreover, Bitcoin's ups and downs are much sharper than those of traditional markets. Yes, if you don't use DCA, you might miss a sudden rise. But if you read the cycles well and reserve some funds for dips, you reduce risk and stay more comfortable psychologically. I want to emphasize that DCA isn't suitable for everyone or every situation, but I strongly believe that every Bitcoin investor should hold some funds in reserve for major market drops. Sure, DCA can be debated, but one thing is undeniable: long-term investing is crucial. I've explained before why you should buy Bitcoin with years in mind. In our increasingly digital world, you shouldn't own Bitcoin for 3 to 4 days. You should buy it as a legacy. This opportunity has only come once in history, a shift from a physical mined asset to a virtual, truly valuable one. If you want your children and their children to benefit rather than regret missed opportunities, you need to start accumulating Bitcoin today. In short, if you prefer a more cautious approach, DCA is an option. If you truly believe in Bitcoin, you can jump in today without waiting. Just make sure to set aside a reserve for the market's bad days. And as always, HODL. 3. Consistency is one of the most important concepts, short but full of meaning and sometimes misunderstood. Being consistent is the most important part of securing your future. We can break it down into two main aspects. The first is the regularity of your investment. If you decide on a fixed amount for Bitcoin each week or month, but give up after a few months, you've abandoned the path halfway. These lapses usually start with small reductions. You decide to invest $300 every month, and by the third month, you think, I'll put in $280 this month. What's the harm? This is the first cost of breaking consistency. Over the following months, the amount keeps shrinking. Some months get delayed, and eventually, investing stops altogether. This is erasing the future legacy you could have built today. Maintaining this consistency is non-negotiable. There's no shortcut. To make it easier, you can use services that automatically withdraw money from your account and invest it in Bitcoin on a set day each month. You can also ask your spouse or a trusted friend to support you. Staying motivated and keeping your routine is crucial. The other consistency mistake is even worse and can destroy your plan entirely. Not only do you stop investing, but you also spend the money you've already saved. This usually happens either because of the first reason we mentioned, or when you notice that the money you've been saving for your dream car is just sitting in your account. At this point, most people start thinking, should I? What will make the difference here is your resistance. This is the moment when you must protect your money. Growth is a good sign, but if you turn that growth into spending, all your effort can vanish in an instant. Do not underestimate this. Do not think, I'm patient, I won't touch it. When you see a large amount in your account, your mind can start wandering. Prepare yourself from today to never touch this money. Whether it grows or shrinks, no matter how big it gets, do not let unnecessary spending, vacations, or shopping destroy your investment before you reach your goal. As you can see, these mistakes aren't hard to prevent. The key is preparing your mindset correctly. Others have fallen into these traps before. Learn from them and don't make the same mistakes. The reason I wrote my book, Legacy in the Ledger, was to guide dads and all parents who are striving for their families. I compiled years of mistakes, the right strategies, well-known pitfalls, and crucial, lesser-known details. If these videos interest you, I can guarantee you'll find much more in the book. Now, test yourself with what you've learned in this video. Like this video and subscribe for not miss out next videos. See you next week in the next video.